we are going to discuss about the financing risk or credit risk. We can use these two terms synonymously for our investment customers. Financing risk related to conventional banking, and that is related to the Islamic banking are quite different. But one portion or one type of financing risk is quite similar. If you think about the conventional banking, the credit risk of conventional banking, and if you think about the uh, mm, credit risk of Islamic banking, particularly for the debt-like Islamic banking contract, you can think about similar type of financing risk. But Islamic bank also has profit and loss sharing contracts that is mainly equity based. So here is the difference. Actually, you will find that for the equity based, okay, mainly equity based investment contracts with the financing customer, okay, you will find that the financing risk is different. Financing risk or credit risk is different. Okay, so uh, profit and loss sharing, PLS means profit and loss sharing. So in that case, actually we cannot have the same type of observation about the probability of default or risk exposure. Because because you are having a profit and loss sharing contract, so you cannot really say that the customer has defaulted, because probably they could not manage to make a good amount of profit, or for their poor business performance. uh, of course they will claim that, because of the uncertainty and all these things, they had to face loss and the capital has impaired or something like that. Okay, and moreover, in case of profit and loss sharing contract, you normally do not have any collateral. Okay, so these are the reason why we cannot really think about uh, the financing risk similarly like the conventional way. We have to think about, we have to have an alternative viewpoint, when we think about the profit and loss sharing financing mode for the customers. So how can we think about that? We will go into detail. So, in summary, we can say that for the profit and loss sharing contracts, the classic definition, this is the main point, the classic definition of credit risk or financing risk is not valid, is not entirely valid, I would say. So, as we have discussed before, for the Mudaraba and Musharaka contracts, we have to amend the definition. We cannot use the same definition of credit risk or financing risk that is used for conventional banking, or that is used for the debt-like Islamic banking contract. Okay. Uh, and the risk associated with the Islamic bank has mainly two types of underlying factors. If you think about different types of risk, not only the financing risk or credit risk, if you think about any kind of Islamic banking risk, there are two main types of factors. You know that for uncertainty or for unfavorable event, there must be some reason, right? So there are two types of underlying factors that may bring in the risk in Islamic banking. One type is uncontrollable factor. For example, the factors that are not in the control of the Islamic bank. For example, the political crisis, political situation, or overall economic situation, geopolitical situation, that means international political uncertainty, the industry issues, that are beyond the Islamic banking uh, control. Okay, those factors, if any loss or if any unforeseen or unfavorable event happens due to this kind of situation, we can say that, okay, the underlying factors are uncontrollable. Sometimes the different types of risks of Islamic bank arises due to controllable factors as well. For example, management issue that is internal to the Islamic bank. So we can deal with the controllable factors very easily, but uncontrollable factors are not that much within our reach. Rather, we have to adjust our banking practices or our management practices to to bypass the uncontrollable factors and risks arising out of that. So for the conventional and debt-based financing, normally when can the default happen? Uh, Remember, now we are not talking about the profit and loss sharing contract. We are talking about the conventional banking, and for the debt-based Islamic banking, the default normally can happen even if the factor is uncontrollable. For example, a business organization has taken loan from the conventional bank, and due to the political turbulence of the country, or maybe war between two neighboring countries. So for conventional and debt-based banking, as I have said, the default can happen even if the factor is uncontrollable. For example, let's say a particular customer, a company has taken loan from the conventional bank or debt-based Islamic banking, and later on, due to the political turbulence or whatever external economic issues, if the business does not run well and it faces loss, and the company may not be able to repay, and default may arise. So you can see that in case of a conventional and debt-based banking, uncontrollable factor can also lead to default. Okay, and also sometimes the default can also happen um, um, for misconduct and negligence, or even if there is no negligence from the customer, still due to uncontrollable reason, the default may occur. But think about profit and loss sharing instrument. In case of profit and loss sharing instrument, that you cannot actually count the default for uncontrollable reason. For example, your Musharaka customer has taken financing from your Islamic bank, and they did not have any negligence related to their business or any misconduct. Okay, but due to the political turbulence or some other factors that is beyond the control of them, and also beyond the control of the Islamic bank, they could not make any profit. Ultimately, they could not provide sufficient amount of return, and even the capital has also been reduced due to the loss. So that is, you cannot claim that as a default, because according to the contract, if there is loss, you have to share it. It is not a default. Okay, but in case of conventional bank or debt-based banking, that will be counted as a default. So for profit and loss sharing instrument, the default should be counted only if that arises due to controllable factors, not uncontrollable. Remember, okay, due to the controllable factor, and also if and only if that is due to the misconduct or negligence of the agent or partner, depending on whether it is Mudaraba or Musharaka contract. Okay, so that is the difference. You have to understand that difference between the conventional financing scheme or debt-based Islamic banking, banking contracts, and on the other hand, the profit and loss sharing based, that means mainly equity based Islamic banking contracts. So the summary is, the definition of default itself is different, okay, for the profit and loss sharing instrument. So you can count an event of loss or capital impairment as a default only if that is due to controllable factor and also due to the negligence or misconduct from the customer. Otherwise, it should not be counted as default. So that is very important difference you should remember. Okay. Now, the financing risk or credit risk related to the PLS or profit and loss sharing instrument in Islamic banking is the risk, and that is the definition we can say after all this discussion. Okay, so what is the definition of financing risk or credit risk related to profit and loss sharing instrument in Islamic banking? Okay, that is the risk that the agent or working partner may not fulfill the contract obligations due to, remember, this is very important, due to misconduct or negligence within controllable factors. So we will count any loss, any unforeseen, any unfavorable outcome as default risk, as credit risk or financing risk related to PLS instrument, only if that is due to the controllable factors and also the misconduct and negligence from the part of the financing customer. Okay, you have to remember that. And of course, there is investment risk through the use of profit and loss sharing based equity instruments, since capital can impair, as I have said, due to loss. However, this can only be accepted as credit risk if the impairment arises due to misconduct or negligence. Okay, that is already clear, I think, to you. So if we think about Mudaraba versus Musharaka, the two main profit and loss sharing based contract, normally it has been found that the major Islamic bankers in the Islamic bank dominated country, or in other words, the countries where we can see the most Islamic banking practices, okay, the Islamic bankers, they have found to rate the credit risk as the primary risk for the Mudaraba mode of financing and as the second important risk for Musharaka mode of financing. So that is statistically found that in most of the Islamic banks, the primary risk of the Mudaraba mode of financing is the credit risk or financing risk. On the other hand, for Musharaka, it is the second important risk. If we think about the factors that are the underlying cause of such credit risk, related to the profit and loss sharing instruments. So that does not include the macroeconomic factors such as real interest rate, unemployment rate, external factors such as regulations, etc., because those are related to uncontrollable reason. And we have already mentioned that uncontrollable factors are not cannot be treated as the reason behind the credit risk or financing risk of profit and loss sharing instrument, because those are really uncontrollable. We don't have anything to do with that. But what are the factors then? Okay, the credit risk factors for Mudaraba and Musharaka are different due to the difference of the nature of control over agent versus partner. So we'll see, what are the different factors that are associated with the credit risk or financing risk related to Mudaraba and related to Musharaka. Those can be a little bit different. Okay. Of course, there are some overlapping, but it will be a little bit different. So let us talk about the factors behind the financing risk associated with Mudaraba financing contract. So the factors are, number one, customers' misuse of capital. Okay, if the customer misuse the capital, that means the customer has taken the capital for one purpose, but utilizing the capital for another purpose. Okay, that is one reason, because the Islamic bank has assessed the customer based on the promised use of the capital in one particular area, but the customer is ultimately using it for another area of business. Okay, so that can be one reason. Another one is if the customer conceal profit, that means the profit, let's say the customer has taken 100 taka of Mudaraba financing, and the customer has made 20 taka profit. But when reporting the profit, when furnishing the information, the customer does not reveal the whole amount. Okay, intentionally the customer say that the profit is only 15 taka, 5 taka profit is concealed. Okay, that can be another factor, the attempt of the customer to conceal the profit. And the other one is, as we have mentioned previously, the customer negligence. Okay, customer negligence can also be the reason behind the risk associated with Mudaraba financing contract. So what kind of negligence? The negligence can be in two areas. One is the business operation level. That means the financing customer has taken the fund, but while running the business, the customer is thinking that, well, the money is actually taken from the Islamic bank, and if we lose, not only I lose, the Islamic bank will also lose money. Okay, maybe that can be the intention, or otherwise, or at least the customer, for whatever reason, if the customer is negligent about the operating activities of the business organization, then we can say that that is one type of negligence that can bring in the default risk. And another negligence is accounting level. For example, if the customer is not serious or is not appropriate in recording all the costs and revenues and all this thing, so ultimately when the customer calculates the profit to be shared, uh, it does not provide the actual profit. Sometimes it provides the less amount of profit. So that is the negligence of the customer related to accounting. Okay, so these are the factors that can be the reason behind the financing risk associated with Mudaraba. Now let us talk about the financing risk factors associated with Musharaka financing contracts. So number one is the information asymmetry between the bank and between the Islamic bank and the customer of the Islamic bank who has taken the Musharaka financing. You know that information sharing is very important because they are the partners. The Islamic bank and the customer, they are actually acting like partners. So if the customer does not provide true information or sufficient information, then we can say that there is information asymmetry. So that can be one reason behind the default risk, because if that happens, then the Islamic bank will not be able to assess the correct level of risk associated with the particular customer. And not only that, not only at the time of assessment, even after getting the financing, after financing the customer, maybe after 1 year or 2 years, if the sufficient information is not provided by the customer, then that can be a reason why the Islamic bank cannot take preventive step to stop the loss. And the second factor is the negligence by any or both of the partners. Okay, both the Islamic bank and the Musharaka financing customers should be treated here. Okay, they should be none of them should be negligent about their activities. Okay, that can also be from the business operation level and also from the accounting level.